All right, Shaun, you're still on mute?
Yeah,
Yeah,
should be all good now.
the class. Yeah, I can hear you. The classic, you're on mute.
Yeah, it will never die.
Yeah.
Okay, so bear with me a second. Right. So I can see that the number of participants is just starting to creep up now. So I think people are joining. So I'll give them 30 seconds or so just to dial. There we go. Start to dial in. Yeah, here they all come. Right. Okay, hello everybody. Thank you very much for your time. I'd like to wish you all a warm welcome to today's webinar, which is Credit Frontier 2024, Decoding Economic Trends for Credit Excellence. For those of you who don't know me, my name is Shaun Rees, and I'm the Product and Risk Director for Bakering International Limited, and we're a collections and legal support company focusing on commercial debt collection. I recently joined Bakering around 3 months ago, November time, following my arrival from VF Corporation, where I spent 7 years working in the field of credit risk and as a credit risk manager. With me on today's panel is the lovely Markus Kuger, a freelance economist who has been working very closely alongside Bakering for some time now. And we also have Ray Massey, who's kindly joined and is the Director of Underwriting for Tokyo Marine. Today's webinar is split into 3 sections, which will consist of an economic update from Markus, an overview from the underwriters at Tokyo Marine, and then an interpretation of how we within the credit industry should interpret all of this information from myself. We aim to keep this webinar around 45 minutes long to allow time for a Q&A at the end of the session. I'd like to just state that you're obviously more than welcome to submit questions throughout the webinar, but we will address them at the end of the webinar. This webinar is being recorded, primarily for redistribution purposes and for those who are unable to attend today. There will also be a report relative to this webinar, which will be emailed out shortly to all of those who've registered for today, and it will be made available on the Bakering website next week. So, without further ado, I'd like to invite Markus to center screen perhaps, to present his findings on what we can expect from the economic landscape in 2024. So, over to you, Markus.
Thank you very much, Shaun, for the introduction. We're still in January, so I'm tempted to wish you a happy new year. The problem with that statement is that when you look at the economic data, I have some serious doubts that this will be a happy year, because it will be another year of low growth and high credit risk. Today, I want to cover 4 different areas of risk. I will start with macroeconomics, then I will move on to supply chain risk, talk about politics, and towards the end of my 20 to 25 minutes, I will talk you through credit risk. But because I have Shaun and Ray with me, experts in that field, I will keep that fairly high level and rather short. So let's jump into economics and let's look at forward-looking indicators first. This is PMI data. PMI stands for Purchasing Managers Index. It's a very widely used concept in the economics world because it exists for many countries. It exists for many sectors, and it exists on a fairly frequent basis because it gets produced monthly. The readings are between 0, which would be very, very bad, and 100, which would be very, very good. The neutral line, hence, is 50. So readings below 50 means things are moving in the wrong directions. Reading above 50 means things are improving. And here, the PMI has several sub-indices, and here you can see 3 sub-indices for 20 different sectors, which are all in Europe. This is European data. And let's start with the output index. Output is the blue bar here, and you can see that in 7 out of the 20 sectors in Europe, output was increasing in December. Doesn't sound too good, 7 out of 20, but in fact, it's the best reading since June 2023. So compared with previous months, this is actually an improvement. You can also see that the sectors that are recording this output growth are mainly in the service industry. Basic materials and consumer goods, they are still performing much worse. Let's have a look at the new order inflow index, the orange bar. Similar picture here. On average, things are not looking good. 13 out of 20 sectors actually report a deterioration of that PMI sub-index. In other words, their pipeline's drying up, which obviously indicates that in a few months' time, output will be negatively impacted. Employment, which is the purple line, also doesn't look too good. 14 out of 20 sectors report a deterioration of the employment sub-index. So to sum things up, things are potentially looking a bit better than compared with 6 months ago, but in a longer comparison with, or compared with a 50 points neutral line, things are actually rather disappointing. Let's move on to consumers. The picture there is somewhat different. Consumer confidence, and I've included the UK figure, which is the orange line, and the EU figure, which is on the right-hand side here, and you have to look at the black line. The black line is consumer confidence on the right-hand visual. And in both regions, both the UK and the EU have recorded improvements in consumer confidence throughout 2023. In the UK, with 2 exceptions, it has risen steadily throughout the year. Started on -45 points, now stands at -22 points. All the 5 sub-ratings that feed into the consumer confidence index in the UK, they've actually improved. However, and the same applies to the EU here, consumer confidence is still in negative territory. So 0 would be the neutral line. It's not above 0, it's still below 0 despite that improvement. Overall, however, you can also see that consumer confidence was on a very, very low level. Look at the EU line here. 2022 was actually an all-time low. And the same happened actually in the UK. Never ever had consumers been so pessimistic about the 12 months ahead than in 2022, both in the UK as well as in the EU. So it was always clear that things will improve, but it will take time until things will go back to normal. Generally, households are less pessimistic about the year ahead than they were 12 months ago, but they're still predominantly pessimistic. That's the message I want to get across to you. John, if you could move us to the next slide, we see one of the key indicators at the moment, and that is inflation. The visual you see here shows UK inflation over the last 2 years, and the different colors represent the different ingredients to the overall consumer price index. So they represent different product groups or different services. Overall, consumer prices have moderated. I've picked the UK here. I could have picked the EU. I could have picked any other developed economy. Inflation has come down across the globe. I'm focusing on the UK here because I believe the majority of the audience will be UK based and can relate to the developments over the past few months. Inflation has moderated throughout last year, and in December it reached 4.2%. Now the question is 4.2% high or low? Again, it's a matter of perspective. It's fairly high if you compare it with the Bank of England's inflation target. That stands at 2%. So inflation is still more than twice above the inflation target of the central bank. However, 4.2% doesn't sound too bad when you compare it with the readings from late 2022 or early 2023. In February, inflation was still above 9%. When we look at the inflation developments, we can also see that with one exception, all sub-indices are making positive contributions at the moment. The outlier at the moment is restaurants and hotels. It's the only sub-rating where prices are still rising, actually compared with the previous month. The rest moves in the right direction. There's also a split at the moment between goods and services. Goods inflation has come down very, very quickly over the last few months, and it now stands at 1.9%. which is actually below the 2% target the central bank has. Services, however, they are still rising by 6%. So 3 times goods price inflation and 3 times the central bank's target. So that is something to consider, depending on in which sector you're operating in. And there's another worrying trend, and that is core inflation. Core inflation is basically the consumer price index, where you take energy prices out, as well as the prices for unprocessed food, as well as, I think, tobacco and alcohol, but they're very small. The 2 important goods here are energy as well as unprocessed food. And it's a concept that is used to measure the underlying price pressures, because food and energy can be quite volatile. You remove that and you look at the more stable stuff, and you can see that core inflation in the UK stands at 5.2%. So it stands above the CPI. Same applies to the Eurozone. Core inflation there is higher than the CPI, the Consumer Price Index. Why is that important? I will talk about that later when I talk about interest rates. If you move us to the next slide, we can have a look at the most important macroeconomic indicator there is, and that is real GDP growth. And here you can see the latest growth projections from the International Monetary Fund. That is from the World Economic Outlook, which was released in October. So not very old, these figures. And the important information is probably here in that light blue box. You can see that global growth is set to decrease further. We had 3.5% growth in 2022. That was already a fairly low growth rate. And from that 3.5% in 2022, it has dropped to 3% last year. We're still waiting for this figure to be confirmed because we're still waiting for Q3, Q4 data. But the estimate of the IMF is that 3% growth last year. And from 3% last year, it will decelerate marginally to 2.9% this year. The world's two biggest economies, that's US and China, they will see decelerations. In the US, growth will drop from 2.1% to 1.5%. In China, it will drop from 5% to 4.2%. So the two biggest economies, they will see slowdowns. In the euro area, the picture is slightly different. Growth will accelerate there, but we have to keep the base in mind here. Growth in the euro area was 0.7% last year, pretty much stagnant. And from 0.7%, it is expected to go up to 1.2%. Nothing to be too excited about. And within the Eurozone, there will be countries that will struggle more than others. One of the countries that will be lagging will be my home country, Germany. It was the only G7 economy where real GDP will have shrunk last year. And in some forecasts, not the IMF, but there are many professional forecasters out there, and some of them expect that the German economy will shrink again this year. So a 2-year contraction, which would be the first time since the early 2000s. So not even during the global financial crisis or COVID or Eurozone crisis has German GDP shrunk 2 years in a row. So this would be a particularly bad year for the German economy. And because the German economy is 30% of Eurozone GDP, it would also impact on the Eurozone performance as well. On the next slide, we see the figures for the UK. And they aren't particularly good either. Here you can see the latest developments according to the Office for National Statistics. The dark blue bar shows the first estimate of real GDP growth, and the light blue bar is the confirmed figure. So you should look at the light blue bar, because sometimes estimates get revised. And that's exactly what happened in Q2 and in Q3. For Q2 2023, the ONS now has expected that the economy has moved sideways, 0 growth in Q2. And in Q3, the ONS has penciled in or had expected that the economy has shrunk. So stagnation in Q2, contraction in Q3, which means the UK is already halfway into recession, because the technical recession is defined as 2 consecutive quarters of real GDP contraction. We're still waiting for Q4 data, but should the economy have contracted in Q4, the UK would already be in a recession. When we look at it, which sector is to blame for that, or which component of GDP is to blame for that performance in Q3, you can see that services were struggling. The service sector was shrinking by 0.2% quarter on quarter in Q3. Production and construction were up, but because service is so big, 80% of British GDP is services, that wasn't enough to lift the overall growth rate into positive territory. Consumption was down, investment was down, which is quite worrying as well, because without investment, it's pretty difficult to imagine some form of booming Britain in 2 years, 3 years time. So that was enough to lead to that contraction in Q3. Government consumption was up and trade was up, but overall, the UK economy is in a very difficult situation. Not as bad as Germany, but the IMF forecasts real GDP growth to come in at 0.7% this year. That would be below the Eurozone average. It would be slightly up from the 2023 estimate. Last year, the British economy will have expanded by 0.6%, according to the IMF. But yeah, if you look at these values, 0.6% last year, 0.7% this year, basically not getting better, and it's fairly close to the stagnation territory. So the UK situation isn't too different from the wider European situation as well. I think that was the final slide about macroeconomics, so we can move on to something a bit more cheerful, and that's supply chain risk, which is also an ingredient to country risk, which is an area I've worked in for more than 1.5 decades. And this chart here shows the global supply chain pressure index, which was created by the US central bank, by the Fed, a few years ago during COVID. And they wanted to measure, well, the name says it, they wanted to assess the stability of global supply chains. And as you can see, there are massive spikes during COVID. Obviously, lockdowns caused mayhem for global supply chains. Once the lockdowns were over, things went back to normal. Things improved very, very quickly. And in 2023, the index had actually dropped below its long-term average. So throughout the first half of 2023, supply chain risk was very muted. Since then, the situation has deteriorated again, however. And that has something to do with two major bottlenecks for global logistics operations. First one's the Panama Canal. There, the problem lies in water scarcity. It hasn't rained in Panama for a long time. The reservoirs are pretty much empty. And without the reservoirs, you can't operate the locks. And without the locks, you cannot send ships through. So capacity has already been reduced. Water shortages allow for a limited amount of ships going through, but not the full amount. And on 1st of February, the capacity will drop even further. From then on, it will be around half of the normal capacity. That, in turn, is causing delays. It's causing higher costs, which isn't good news for supply chain integrity. The other canal that's impacted at the moment is the Suez Canal. No water shortages there. The problems lie in the political field, not even related to the Suez Canal as such. It's more related to the Red Sea, which obviously is connected to the Suez Canal. And at the entry point to the Red Sea lies Yemen. Yemen has suffered from a civil war for many, many years. And one of the groups involved in that civil war, sure you've heard them, if you've read the newspapers recently, are the Houthi rebels. And the Houthi rebels have started to attack vessels that pass that very, very narrow strait at the entry point of the Red Sea. That has caused rerouting of ships. Several logistic companies, including Maersk, one of the biggest ones, they are now no longer using the Red Sea and the Suez Canal when they ship goods from Asia to Europe or vice versa. They're now going around the southern tip of Africa. Again, longer routes, higher costs, more trouble for supply chain integrity. On top of that, we have seen shipping costs rising throughout the last few months as well. On top of that, we have labor shortages in the sector. So all of that is causing problems. Of course, supply chain integrity is much, much higher than it was during COVID, but nonetheless, it isn't as good as it was 9 months ago, 12 months ago as well. That brings us to the next topic, which is political risk. 2024 will be a very important year because half of the globe's population will elect a new leader or a new parliament. That is mainly driven by India, which is now the biggest country in the world. So there will be parliamentary elections in India, but several other key countries or regions will also see elections. In Europe, in the EU, I have to say, there will be a new European Parliament this year. The UK will see elections this year as well. And obviously the biggest impact on the global economy will be the US presidential and parliamentary elections in November. As things stand, it seems possible, to use understatement here, it seems possible that Donald Trump will be re-elected, possible to quantify what that will mean for the global economy. But given how erratic things were in his first term, it's fair to say that it will complicate business planning on a sizable scale. At the same time, we have this longer-term trend of Western democracies, or some of them at least, slowly transforming into liberal regimes. The far-right parties are expected to gain a lot of seats in the European Parliament. They're likely to gain any importance there, but nonetheless, there are several countries in Europe where the far-right either runs the country, look at Italy, for example, or where they are the kingmaker in a coalition, or where they are expected to do particularly well in the next upcoming elections. On top of that, we still have a war in Europe, completely unclear when the Russia-Ukraine war will end, how it will end. And although the economic impact of that has come down, it's still impacting on, for example, the agricultural produce market, on hydrocarbons. That is all distorted by that war. And then we have the US-China conflict as well, dubbed the new Cold War. It's unlikely that an armed conflict is imminent, but both sides are investing heavily in their capacities. And the region or the country to watch there is obviously Taiwan. The Chinese want to retake the island. And there's been a study from Bloomberg Economics, and they are estimating that should there be a blockade of Taiwan, which would obviously then lead to sanctions and counter-sanctions that would involve the two biggest economies on the globe, that would cost around 5% of global GDP. So blockade, sanctions, 5%. Should there be a war, costs will go up to 10%. And just to give you an idea how much that would be, or within perspective, COVID cost 6%. Global financial crisis cost 6%. So Taiwan is of very high importance simply because of its of the location of many semiconductor chips producers there. It's very close to global shipping lines. So should there be a war, again, it's not imminent, but it's a potential risk that would cause massive knock-on effects for the global economy. That brings us to credit risk. Again, I will keep that fairly short because I know that both Shaun and Ray will talk about that. I will start with payments performance. That chart here shows the average payment delay in days in Q3. It's from Dun & Bradstreet, and it's beyond agreed terms. So when it says 6-7 days in Germany, that's not the average payment delay. It's the average payment delay beyond terms. Payment terms in Germany normally 30 days. So on average, you get your money after 36, 37 days. That's how you would need to read that chart. There was a surprise in Q3 because payment delays have come down, at least on European average. It now stands at 12 days. In Q2, it stood at 12.5 days. It was surprising because in Q2, figures had actually deteriorated. And I had expected this trend to continue in Q3, given how bad the economy was doing, given how high interest rates are, given how poor confidence indicators are. I would have expected that this deteriorating trend would continue. The opposite happened, and I cannot really explain why that was. I think it's an outlier, and 2024 will see further deteriorations. When we look at the UK, we see that payments performance in the UK has actually improved for 5 consecutive quarters. So the short-term performance of the UK is good. However, I remember when I joined Dun & Bradstreet in 2010, the UK actually had a better than European average payments performance, and throughout the last decade has actually slipped below that European average. The good news is that it has overtaken France last month. So the UK has leapfrogged France. Always a bit of animosity there between the UK and France, but overall, the payments performance have improved, but I think this is not going to last. If you move us to the next slide, we see insolvencies in the EU. Similar story here. Unexpected improvement in Q3. In Q3, a number of business failures in the EU dropped by 6%. However, when you look at the development in 2020 and the first half of 2023, you see that there have been very, very steep increases in the number of business failures. When we compare the current reading against the last pre-COVID reading from late 2019, we see that the overall figure has actually increased by 3%. But again, that's an average, that's an overall figure. Certain sectors are actually recording lower business failures, but others are recording figures that are above the pre-COVID reading. And the worst performer in this light is accommodation and food services. Figures have increased by more than 30% if we compare the last figure against the pre-COVID reading. If you move us to the next slide, Shaun, please. It shows the development in the UK. I'm apologizing to everyone who's from Northern Ireland and Scotland because this is actually not UK. This is England and Wales. However, given that England and Wales account for 95% of all UK insolvencies, I thought it is okay to use a chart that shows England and Wales and label it UK insolvencies. I'm aware of the fact that Scotland and Northern Ireland are missing. Nonetheless, the developments are very similar across the 4 nations. Insolvencies are going up in England and Wales, as well as in Scotland, as well as in Northern Ireland. And in England and Wales, they have increased by an additional 2% year on year in December. And because we have December data now, we have the full year. And I know that Ray will talk about that. So just a bit of a spoiler alert, it was the worst year since the global financial crisis in terms of UK insolvencies. My next slide is the summary page. So that shows that we are getting towards the end of my 20-25 minutes. I want to remind you of the key messages that I wanted to get across to you today. From an economic point of view, things are looking fairly bad. Economies are already in a recession, might fall into recession soon. And if they're not falling into recession, in Europe, growth will be fairly weak. So you shouldn't expect too much tailwind from the macroeconomic side. When we look at inflation, the picture is a bit better. Inflation has come down and will continue to come down in 2024, but the pace of that improvement, that will slow down. So we are at 4% inflation in the UK at the moment. We had 3% in the Eurozone, and that pace of improvement will slow down. We won't be at 2% in 3 months' time, in 6 months' time. That will, the final mile is always the most difficult stretch in that performance. Because inflation is coming down and because the economy is performing poorly, what's going to happen with interest rates? And many observers, including myself, expect interest rates to go down this year. However, when I say they will come down, I have to put that in perspective. Obviously, they went up very quickly in 2022 and in the beginning of 2023. So we won't see that pace swinging in the other direction. So it won't be a 50 basis point cut this month, followed by 75 next month, following by 50 the following month. It will be the usual 25% cut, then 3 months break, then another cut. And that's another problem. There is still a lot of underlying price pressure in the system. Wages are still growing fairly robustly. We had core inflation that's still fairly high. We have geopolitical risks that are impacting on commodity prices. So oil is probably not going to get much cheaper. So all of that is keeping inflation higher for longer, which means that these interest rates won't come before the second half of the year. I haven't talked about the labor market in my presentation. There wasn't any time for that. Just a few bullet points here. The labor market is cooling down. Number of job vacancies is going down. Unemployment rates going up. Wage growth is slowing, albeit from a very high level. But that doesn't mean that we will get mass unemployment soon. The opposite will happen. We will still continue to face shortages of labor in many, many sectors. So if you are having a vacancy in your team, don't expect on you finding candidates much quicker than a year ago. So things will get a bit easier, but not much easier. So, and final bullet point here, let's bring this back to credit risk. Growth is negative or very low. Interest rates are high. And at the same time, it's not only interest rates that are problematic, it's also lending conditions. When you look at the latest bank lending surveys, both for the Bank of England or the ECB, you can see that banks have tightened credit standards recently, and they expect this trend to continue. So not only do you have to pay a fairly high interest rate on a loan, you also need to fulfill much tougher criteria to qualify for that loan. So all of that is complicating access to credit, taking out new debt, rolling over existing debt, which in turn will lead to higher credit risk in 2024. And I know that Shaun will talk you through what you can do against that. On my last slide, I just want to remind you that you can ask us questions. Please use the Q&A button at the bottom of the Zoom application. I'd also invite you to connect with me as well as Bakering on LinkedIn to stay informed about upcoming events and papers that have been released. And I also want to alert you to the fact that there is a very helpful resource tool out there. It's the Global Outlook section on the Bakering homepage. As Shaun has said, I've authored the Global Outlook report, which will explain the slides in a bit more detail. It will be sent to you automatically today or tomorrow, and it will also be put on the Global Outlook section. Global Outlook doesn't mean there's only macroeconomic stuff out there. There's also content about certain sectors. There are also collection practices in certain countries and regions. If you haven't done so yet, please visit that homepage and have a look at it. Shaun, that's all I wanted to talk about today. I said, happy to take any questions at the end of the 3 presentations at the end.
Excellent. Thank you very much, Marcus. Much appreciated, even though it's a doom and gloom, a doom and gloom overview with very few shining lights. Let's hope there won't be any drastic events throughout this year to exacerbate any of those problems. I'm now going to invite Ray, Director of Underwriting for Tokyo Marine, to centre stage to provide his overview from the credit insurance perspective. So over to you, Ray.
Thank you, Shaun. Well, I guess a la weather forecasters, you shouldn't shoot the messenger. But the best thing I heard there from Marcus was that we've overtaken France in something at least. Yeah. Good afternoon. Name's Ray Massey, Underwriting Director, TMHCC Credit. That's the credit insurance arm of the group. I've been underwriting trade credit in the UK for 35 years now for my sins. The last 8 years or so at TMHCC. And I just briefly, Shaun just asked briefly to try and translate that economic environment that Marcus has outlined into what in practice is going to mean for the credit insurance underwriting market in the UK in 2024. So, into the summary slide. There's probably two general things to say for me on that in relation to what Marcus has just said. One, what will the environment actually be like for insolvency specifically in the UK in 2024? The honest answer is, of course, who knows exactly, but there has been a number of quite reputable surveys in recent times suggesting that the UK could actually experience 30,000 corporate insolvencies in 2024. That would be an absolute record in number terms, should we hit that. But also historically a very negative number as a proportion of live UK companies. But I would say, regardless of whether we actually hit that number or not, regardless actually of whether the UK falls into recession or not, as Marcus says, we could shortly be confirmed as so. Either way, even if the UK gets close to that rather unfortunate number, it suggests clearly that 2024 is going to be a very difficult environment in which to manage receivables in. Where do we think that would be most adversely impacted? Well, I think one can say with a reasonable amount of certainty, unfortunately, that construction will lead the way in insolvencies in 2024. The sector does most years. It often actually contributes to the proportion of insolvencies in the UK that's up to 50% more than its proportion of GDP. There's a number of technical reasons for that, not a criticism of the industry at all, which we don't necessarily have to go into today, but it is a difficult market prone to insolvencies, there is no doubt. Following that, we would be looking at retail, haulage and fuel, and leisure and dining as areas of particular stress this year, one would say, for a number of reasons, a number of different reasons impacting them to different extents. But you can imagine many of them. Cost pressures, margins, reduced demand from our cost of living crisis, and staff shortages will all be included to various degrees in those areas. So what would the second part of that question then really would be, what therefore do you see as the impact on the credit insurance market? And the expression we use, the possibly jargon expression we use, will be that of a hard market. I would expect to see credit insurance be in a hard market in 2024, which means in practice two things. One, commercial terms being harder to obtain. Underwriters will commercially decline more requests that come on the desks, I don't doubt. And possibly some...
Ray, can I just interject and just ask you to turn your camera off? I think we're having some sound issues with some, just intermittently, just to see if it helps.
Am I flicking? Am I?
A little bit. Try again.
We'll try that. How is that?
That's smooth. Yeah.
Is that coming across better?
Yeah.
Beautiful. Yeah. So commercial terms harder to obtain. Some underwriters actually possibly making a decision to exit entire trade sectors. Wouldn't be surprised to see. And those terms that are obtained are liable to feature increased premium levels and or tighter structures. But the second part of a hard market, as we call it, is really risk appetite, and the extent to which underwriters are willing to write the credit limits on people's customers. That really is the guts of a credit insurance policy. That risk appetite you can see reducing in 2024. So really the question is, what is the answer to combat that? How does one get around that? And the general answer really is for the prospect, the client and the underwriter to get to know each other's businesses. Credit insurance policy is very different from the type of insurance policy one puts in a drawer and only reads when a claim event has happened. It's a longer term dynamic investment. That, as I said, they come to four difficult environments, but really involves the policy and the underwriter becoming intrinsic and a partner to the prospects control function and team working together, one supporting the other. So the huge knowledge and understanding of other businesses, trade sectors, clients and customers is unrivaled. So that really is the long-term answer to how you get round, as it were, a hard underwriting market. Our approach, shown on the further slide, our approach in that market really comes down to the first box there on the left. It's to try to provide a stable long-term partnership and support for that credit function within the business. And how do we do that? It's a combination of the two, really. It's experienced and empowered underwriters, senior experienced people who know the policy, who know the clients, who know specialists within some sectors, and alongside a bespoke operating system that we continue to develop, that between them provide quick decisions, clear quick decisions, and also most importantly, decisions, explanations and communications from actual people. We don't believe in sector approach decisions. We don't make decisions per sector. We look at people on their merits and always will, and believe fundamentally that whatever the environment, however difficult this year or subsequent environments become, there are winners and losers in every industry, and your job as an underwriter is to pick them. Some things that we think people may want to see in a credit insurance policy on the next slide, Shaun, in most environments actually include things like the ability for multi-currencies, policy to cover people in multi-currencies, quite possibly sometimes with the actual same customer. Recognition and individual flexibility around people's retention of title arrangements and clauses. A clear and commercial approach to what constitutes a binding contract. And perhaps when push comes to shove, most importantly of all, an ability to get claims payments paid quickly. We have a facility that can make payments via backs within 24 hours of the claim being received, within certain parameters, of course. There's a couple of other things there as well, but that really is our belief. Unfortunately, you could say, but the consequence of that kind of difficult environment the market is talking about, and that is the only way to get around it. Really, it's to work with the underwriter, and we should be open and honest, and the people get to know each other's businesses in a nutshell. Shaun, that was me really quite quickly. Over to you.
Okay, thank you very much, Ray. I think there were a couple of sound issues there, but the message was overall clear. Yeah, it seems that a few members of the audience have highlighted it, but the message was received. Thank you very much for your input. I mean, it does seem that you have the same doom and gloom approach as Markus, which isn't ideal, but it's certainly useful to get your perspective.
I know. I mean, perhaps we should blame Markus, in fairness.
I'm okay with that. Right, now I'd like to move on to talk about what this means for credit individuals and how the economic changes and forecasts impact businesses and the various actions that we need to take. So, obviously, just to quickly run through the main risks that we're facing that both Markus and Ray have touched upon. We've got technical recessions which we're facing. We know that a recession is indicative of lower consumption, reduced investment, lower government expenditure, reduced net exports. With consumer confidence rising but still negative, there's less footfall, there's less conversion, fewer visitors to e-commerce platforms. And that obviously impacts the businesses who are already dealing with inflated fixed costs and an increased cost of borrowing. The lower confidence leads to reduced consumption, which then affects the business revenue, worsening margins, lower profits, and hence less investment in business because there is a lack of healthy return. Overall reduced cash, we're aware that this means there's less cash to pay suppliers, and it's going to result in an increased overall payables days. Our businesses are obviously facing inflationary pressures. As Marcus has touched on, the energy crisis is not over, but we're on let's say, the other side of the hill there. With markets having shifted from their main energy source going via Russia or Ukraine to getting their own, whether it be markets such as, I believe, Spain and Portugal, who focused on renewable energy. Inflationary pressures remain there. Marcus touched on core. Food inflation is obviously quite a big one, certainly impacting those credit departments who are operating within agri-food, within services, hospitality. All of the inflationary pressures essentially force a reallocation of household budgets and hence redistributes the disposable income for the end consumer, which means they have less income to spend on luxury goods. So those things such as holidays and tourism, less to spend on apparel or to spend on health and beauty. All of these kind of products and commodities are going to be deprioritized naturally. We're also facing the rising interest rates, which has peaked. My mortgage is due for renewal in April, so I'm really hoping they come down massively in the next 2 months. Previously, we weren't in a liquidity crisis within COVID. Government supports were there. We had furlough. We had, especially in the UK, we had bounce back loans. We're entering a different phase now, whereby people are reliant on that extra funding, the cash that they can get from a bank. But these high interest rates are obviously driving more focus on interest-free third-party funding, i.e. credit limits from suppliers. Fixed costs are up. We know that mortgages are more expensive. Commercial rents have increased. All of this, again, not only affects let's say, the income of a business, but it also affects the household income of the end consumer who has less to spend, certainly on luxury items. And then the insolvency rises. I mean, we're all very much aware that the insolvency rises, despite that slight little dip that Marcus showed in his visual. Worsening business performance with high fixed cost bases, they're not decreasing. Our businesses are experiencing worsening margins, lower profits, job cuts, less cash, more support is needed. Payments are going to be missed, write-offs are going to increase, debt provisions are needed. There's going to need to be more support for litigation cases and for collections, certainly for debt collections as well. So all of this then begs the question, essentially, what do we do as credit professionals? How should we be approaching those times ahead? And with interest-free supplier limits the best source of liquidity, ideally on which there are no specific terms or no specific covenants, there's now a much higher credit risk for credit departments to deal with, and we have to take action quite promptly. So what we're facing is essentially systematic risk. We're encountering this. It's going to be all markets, all sectors, all channels, perhaps on slightly different scales, to be fair. But the most efficient way of combating such unpredictable large-scale risks is portfolio diversification. Avoid putting all your eggs into one basket of that large customer who can make, to offload stock. It will avoid them having leverage over a specific credit department as well, and it overall will reduce the risk, spread the risk across the customer base. We then need to look at our risk assessment criteria, our scorecards, our models, those which were previously effective, consider historical data. Historical data bit with historical risks. So, if we're looking at financial accounts, COVID has quite clearly warped the accounts. There was an influx of cash in the markets, revenues were down, there were government supports. There is no clear trend for us to follow and to be able to assess. New methodologies need to focus on cash, they need to focus on liquidity. We need to be looking at things such as the operational working capital cycle and the various terms and covenants on the loans that businesses have with their banks as well because of the high interest rates. Ideally, the financials we're looking at should be from specific audited management accounts from the business, or certainly forecasted ones. We need recent up-to-date information. And this also extends to your days sales outstanding, your days beyond terms, whatever payment information that you can get. It will help to analyze customer behavior and obviously give us the most recent indicator of whether a customer is under or, well, either performing or not. Communication should go without saying. We're all in the credit world. We all know that communication is key. We need to make sure that we're having regular calls, regular emails, meetings face to face with our client base where we can, to understand, well, to identify changes in behavior, be aware of the customer's situation, make sure that we know exactly what is or what isn't happening with the business and what challenges they're facing. It's about capitalizing on the networks, attending webinars. I used to attend forums in my old role, where I will be able to speak with suppliers who worked with other customers, and you would get an insight into what's their relationship like with those businesses as well, to pick up on things that you wouldn't normally experience. And then obviously making sure that you're advising your senior stakeholders, your directors, your chief risk officers of any red flags. You need to make sure that the provisions are in place for the bad debts and the potential write-offs. We need to look at collection strategy adjustments. If you're going to diversify your portfolio, obviously then we need to be looking at adjusting how we're collecting, whether it be tiering for specific customers, whether it be key accounts, whether it be changing the payment methodologies, moving towards direct debits, avoiding checks, avoiding credit cards, reducing terms, reducing limits. All of this needs to be considered, especially within such a potentially volatile environment. As credit professionals, we should all have our risk mitigation strategies in place, in addition to our risk assessment criteria. So, Marcus, correct me if I'm wrong, but hopefully the euro won't change in terms of strength significantly. If it could improve, that's always a benefit. But it's not a particularly volatile hard currency. Hedging for those markets whereby we have seen and we have witnessed recent volatility, if we consider Russia and and their currency and how that's fluctuated. Hedging is one way to cater for that. Collateral in terms of internationally recognized securities, standby letters of credit, guarantees, bank guarantees, parent or personal guarantees as well, if that's a potential option, and also a reassessment of the risk appetite. Many businesses opt for a risk appetite which promotes growth. If you need to be doing that to be able to recuperate any losses, then perhaps you need other cover in place, whether that be through something like Tokyo Marine with credit insurance. Exit strategies, especially if we've got customers that are on the cusp of insolvency, we need to make sure that the correct provisions are in place. We've got the right bad debt amounts listed within our accounts. We need to know how to redistribute our stock to our existing customers, hopefully the healthy ones, let's say. We need to make sure that we're able to avoid significant credits when we have returns. Store closures and takeovers need to be clear. We need to have a continued succession plans in place for those businesses that are not going to be able to survive. And ideally, the idea is to avoid any potential litigation cases, claims, or credits, and plans to recover the stock. And then my last one is mitigating the number of insolvencies. I mean, both Ray and Marcus have touched on this impending wave that we seem to be riding in terms of the number of insolvency cases that we're experiencing. In theory, if your risk assessment criteria is correctly flagging cases, take the action. But also we shouldn't be holding on to uncollectible debts for months and months and months when, these can be moved over to debt collection agencies such as Baker Ing. The longer a debt is left untackled, the less success a collector is likely to have. We need to be flagging our bad debt cases, make sure that there is the support from the relevant legal teams within our respective businesses, and make sure that any onboarding teams and the credit risk teams are aware of Phoenix companies who are trying to capitalize on the support that we offer as credit professionals. And there's the overview. So hopefully this should give a good overview of the direction that credit professionals and departments should be taking with a view to the ongoing challenges brought about by the current and forecasted economy. At this point, I'd like to thank Marcus and Ray for their contributions, and I'd once like to reiterate Marcus's point regarding his report for the webinar, which will be emailed out to all of those who registered for today's webinar, and will be added onto the Baker Ing website in due course, I think next week. So now I'd like to take the moment to address those questions which have been submitted via the Q&A chat facility. Obviously, if any of you have any questions, following following the closure of the presentation, and please feel free to submit them. I'm obviously conscious of time, so we'll try and get through as many as we could. Any which could not be addressed, we'll try and make sure that they're catered for as well with the distribution of the slides and the report. So I will stop my sharing and then I will ask the Q&A. There we go. Right. Q&A. We've got a few for you, Markus. Hope you're ready.
Yeah, I see them as well. Shall I read them out?
Feel free.
Okay.
Yeah, feel free. Feel free. You go ahead.
So I will answer Patrick's question first because it is very easy to answer one. The others are a bit more challenging. Patrick wants to know about the developments in the European late payments legislation. When will the new proposal for a stricter payment behavior law will be presented to the European Commission? And when would this new law be valid? I don't have any details on that. I can tell you, however, and that is nicely a link to what Shaun just reminded you of. There's a global outlook section on Bakering, and coincidentally, Bakering has just released a study about the European late payment directive and the incoming changes. I'm not sure if it will answer all of your questions regarding timelines, and as always with European policymaking, that can be tricky, but I'm sure there will be a lot of valuable information in that report. So go to Global Outlook on the Bakering homepage, and hopefully that will answer the majority of these questions. If there's still questions, please reach out to me or Bakering via the channels that we have told you about, LinkedIn or email. The other questions I said are a bit more economics related and nonetheless tricky to answer. The first question is, how do you anticipate emerging markets will respond to the economic trends you described, particularly in relation to credit risk? So I've told you about the economic performance in 2024. Global growth will be weak, the weakest in many years. The World Bank actually forecasts even lower growth, 2.4%. The IMF says 2.9%. And this isn't a story of emerging markets doing well and industrialized nations doing poorly. No, literally across the board, this is a slowdown in global performance. Not surprising given how closely interconnected the global economy is nowadays. I can tell you that the best performing G20 economy this year will be India. They were the best performing G20 economy last year already. So India is doing well. There's this talk about India becoming the new China because China having all these problems. Yes, India is catching up, but it has still a long way to go. Another question was, could you provide more insight into how the evolving geopolitical landscape might impact global trade agreements and credit policies? Yeah, I said the far-right parties are making substantial gains in polls and in elections, and normally the far-right was always small state, free trade is good, but these stances have changed recently. So if you look at Donald Trump, he's obviously quite right-leaning. Nonetheless, he favors subsidies for American workers. In France, the Front National, they favor subsidies for French companies and French workers. So just because you're far right these days doesn't mean that you are advocating for free trade deals. Quite the opposite is happening. So I think it's unlikely that any major new free trade deal will be signed over the next few years. There's a severe risk of existing deals being cancelled or being changed. That will all impact negatively on the free exchange of goods and to a lesser degree services. Last question, in your analysis of sector trends, which sectors do you foresee having the most significant rebound or decline in the upcoming year? I said, when you look at the forward-looking indicators at the moment, you see that confidence indicators have rebounded in the service sector predominantly. The manufacturing sector is lagging. So from that angle, you could say services is doing well or doing better than manufacturing. However, when you look at inflation, you see the complete opposite. The service sector is still experiencing very, very high inflation, while in manufacturing, price pressures are less obvious. In fact, in many sectors, prices have started to come down because commodity prices have fallen. So in that light, the picture is very different, which makes it difficult to answer the question which sector will rebound. When you look at the UK in particular, the recovery in the UK services PMI is predominantly driven by the financial industry, and it's also driven by financial, and the other one was technology. These were the two drivers in the UK. So from a UK perspective, these sectors are more upbeat than others at the moment. My last question, before I hand it back over to you, Shaun, is UK interest following the same pattern as Europe for 2024? In a nutshell, yes. The price pressures in the UK are still a bit higher than in the Eurozone. Inflation in the Eurozone is 3%. In the UK, it's still above 4%. Nonetheless, markets have priced in interest rate cuts in both geographies, but markets have also priced in fairly aggressive interest rate cuts and fairly quick interest rate cuts. I don't think that this will happen. As said during my presentation, I think interest rates will go down, but they will go down slowly, and this process is likely to start in the summer or even in autumn this year. So the UK will follow the Eurozone developments, or the other way around. They will move in sync, but the movement won't happen anytime soon, which, Shaun, is bad news for you and your mortgage, I guess.
Thanks. Yeah, not looking forward to that discussion. Okay, Ray, I believe there's a question in here that was asked when you were presenting. So assuming there's no sound issues, how should businesses adapt their credit risk assessment models to better forecast and manage the risks associated with technical recession?
Yeah, I saw that one. I think going back to what I said earlier, whether we end up in technical recession or not, or whether we actually went in at the end of Q4 or not, probably the question is what a lot of sectors are going to be facing is flatlining, is stable at best, or declining demand. So, you know, almost the question to me is how are you facing that situation when, despite inflation, relatively, you know, high numbers of inflation, you're not seeing increased top line. So it's that, isn't it? So it's efficiencies. It's coming down to you to right sizing the business and looking at efficiencies across the board, processes, people, to try and recognise that over the medium term, certainly over the next 12 to 18 months, you're not going to get salvaged or rescued by increased sales. Yeah, I think it's as simple as that. I think in an awful lot of industries, certainly traditional industries that we're looking at, you know, an awful lot of quite traditional manufacturing and distribution businesses are buyers of credit insurance, and those kind of sectors are going to see flat top line at best, unfortunately, I think, in 24.
Okay, thanks, Ray. The next one is from Tracy. Do you find that businesses across all sectors are still not investing much or at all in good credit management policies and training or upskilling? I mean, I can answer that based on the sectors in which I've operated, and I would say it's not the priority. Sadly, I don't know if your experience is the same, Ray.
Yeah, I was going to say that. I didn't know what your experience was. Unfortunately, I thought, yeah, that is the case. It feels very much across a number of industries that I've dealt with and worked with over the years, that, you know, the credit team, the credit management process is the Cinderella of the business. It's the last thing, and almost as if it's the least important, rather than the old adage about, you know, you really haven't made a sale until you've been paid. That in terms of investment and decision making, investment, it often seems to be the Cinderella in the business.
Yeah, it's not the priority. It's been deprioritized because of other losses. And I think anybody who's operating within the training or upskilling sector, always had roles within, you know, learning and development, will know that those are sadly the departments that get cut first whenever there's a period of, let's say, tightening and cash shortages. So I would very much say that from those I've spoken with, that is not the priority.
Yeah, unfortunately.
Yeah, I would agree. The next one is, we've got time for one more. If you had to advise a startup on one critical risk management strategy in the current economy, what would it be and why? Oh, what a question.
Yeah.
Right. Yeah. Do you want to have an attempt first, Ray?
I don't know, but what I'd be interested in your view, sure. I mean, for me, it's you know, ultimately a business needs sales. You know, everything drives from the top line and drives down from that, obviously. But there can be, certainly in new businesses or in startup stages, there can be a temptation to be over keen with that. I think we've all seen. And to say that silly adage that you haven't made a sale until you've been paid is so true. And it is so much about, if you can survive early doors, then it's about the integrity of your customers, that they're going to pay you and they're going to stick around and they are creditworthy and they're there for the long haul, rather than simply getting sales from anywhere in the first 12 months. I mean, that is a temptation when you're starting anew, clearly. But if you surround yourself with difficult, high risk, poor paying businesses, that's not a viable medium-term plan. You know, you've got to try and survive and pick your customers early doors.
I was going to say very much the same sort of thing in terms of don't put all your eggs in one basket and start reaching for the skies when you've got the high risk client base who could quite easily take advantage of smaller startups, certainly at the beginning.
Yeah.
Right, we've had our hour for the webinar. So what I will do is I will take note of those remaining questions, which I have done, and they will be addressed separately. For now, I'd like to thank, first of all of the attendees for attending and participating and for taking part within the Q&A. It's massively appreciated. We hope that this webinar has been highly beneficial for all of you. And I'd like to also thank Markus and Ray for taking the time today to join this Bakering webinar. It's been hugely appreciated, and thank you very much.
Thank you.
Right, I will now stop the recording and close the webinar. Thank you very much, guys. Have a lovely day.
Cheers, guys. Thanks all.
Bye-bye.